The ratio put diagonal is my hands down favorite bearish options trading strategy. So I'm going to walk you through how it makes money, how to set them up, how to scan for them, how to manage. I'm going to give you an example of a trade that I had earlier this year that shows the full life cycle and decision cycle along the entire path. I'm going to show you a trade that I have on right now so that you can see how I found it. And then at the end of the video, I'm going to go through a couple questions from our Discord members, which you should join. And as you could tell, there's a lot of detail going to be in this video. That's by design, so it's going to be long. Feel free to skip around as needed, but I want you to have a good reference benchmark for the ratio put diagonals, because this is a staple of mine. Now, if you're familiar with the channel, ratio diagonals will be very familiar to you because I trade them quite literally all the time. It gives me a bit of a more adjustable risk reward profile, which we'll talk about. So the ratio put diagonal in a nutshell, it's a directionally leveraged trading strategy designed to benefit from the downward price direction of something, whatever it is that you're trading. And it has a few legs. You'll see that there's two primary legs, and then there's kind of this optional leg, which we'll get into in a little bit. But the primary leg to start with is an in-the-money put that's greater than 60 days to expiration. So let's talk about those two components specifically. Why in the money? Why greater than 60 days to expiration? Great questions. The first question of why in the money? This allows me to do two things simultaneously. The first thing is I limit my theta decay. The further in the money you go, the more expensive your option will be, but the less time value and the more intrinsic value will be in that option. So if you get the moves that you want, you're paying more upfront, but you're going to recoup the vast majority of that cost, even if it doesn't move much, because it's intrinsic value that doesn't decay. The second most important thing is you get a better dollar for dollar move in the underlying. What does that mean? Let's take a look. The example that we're going to use for the previous trade is O. And I originally started trading this to the downside a while ago when real estate was doing really poor the beginning of this year. So what I had on, we'll walk through all of that. I'm just going to use it as an example now for some of the option selection criteria. So if O goes down by $1, if I have something like these 91 delta puts, I get 91 cents for the dollar. So that means that as O is moving, I'm seeing as much of that same move as I can with the options. What's the downside? They're more expensive. The other downside is your options aren't going to get those massive 1000% compounding returns without a huge move. So you have to figure out what's right for you. And this is why we also add those kicker options sometimes. And the way to think about those kicker options, at least for me, is if I have some sort of stronger conviction and I really want to try to amplify the potential move, if I'm correct, I will buy cheaper out of the money options, either the same expiration or closer in time, depending on what the chains look like. And what those do is they don't give me a big profit if we get a smaller move. So if O moves $2-3, let's say we grab these 50s delta puts as the kickers, it doesn't really matter. It's not going to benefit us that much. But if O, for whatever reason, craters and falls out of bed, these will compound very quickly, gain a lot of gamma very quickly, and then these can actually add a lot of profit potential. So this is kind of like a lower probability play that can amplify the overall return profile. So we now know why I select the deltas that I do. My general approach here is in the money. So that means greater than 50 delta. The vast majority of the time, it will be greater than a 60 delta. Sometimes I will go as far as a 1 delta. My typical target is around an 80 delta. Now, this is completely predicated on the options chain. So for example, if this was the trade I was looking at, 94 DTE, which we'll talk about why that DTE is compared to something else in a second. But if we take a look, the 59s or the 91s, which would I pick? I actually would pick the 59s. Why? Because of liquidity. This is something that a lot of traders, especially smaller traders, don't think much about, because fortunately, if you're trading a 1 lot, a 2 lot, it doesn't really matter. But if you're trading a 50 lot, a 100 lot, this is actually super limiting. So you'll find that these odd strikes, like the 57.5, the 62.5, they will have much lighter liquidity than the standard strikes, like 60, 55, so on and so forth. So part of it is finding the right mix, balancing all these different things, which does absolutely include liquidity. The reason why liquidity is so important is because as you go further out in time, liquidity will lighten. As you go deeper in the money, liquidity will lighten. So you can't be too hands off with your attention to liquidity, because you need to exit the trade. That's how you make money in this thing. You have to be able to sell the long options for a big profit. So if you're trading something that you're really forcing, trying to get your way in, that can be really difficult in order to find a reasonable exit point. So that's why you have to find a balance specifically with respect to liquidity in the options chain. Now, as we look at the different expirations, we know theta decay accelerates once you get within 60 DTE. So the vast majority of the time, my long options will be greater than 60 DTE. I will then bracket by how long I'm expecting to hold the trade. Sometimes I'll go 90 DTE. Sometimes I'll go 180. Sometimes I'll go way out over a year if it's something I'm really expecting to hold for the long term to the downside. So it's completely variable depending on how long I expect to hold a trade. Sometimes I'll even go into 30 DTE. If it's something I'm expecting to hold for a week, maybe up to 2 weeks, but about a week, sure, 30 DTE is fine because you're not holding it that long. And by going deeper again in the money, you still limit your theta decay. So you can, again, figure out what expiration makes sense for you. The further out in time you go, the longer your trade has to work in your favor. The lighter your theta decay is going to be, the more expensive your options are going to be. So you got to figure out what's right for you there. Now, let's talk about the rest of this structure. I just walked through all of the details essentially on thinking about the put that you might purchase. For the short out of the money puts, these are secondary. So the primary profit mechanism, the driver of profit in this trade, is the long puts. You cannot forget that. So when we're adding these short puts, they're designed to amplify the returns. They give us a little bit of premium up front. They help us offset the cost of gamma or leverage, depending on what delta you pick for your longs. These are designed simply to supplement the position. I bring that up because what you don't want is to try and get too greedy and collect too much money up front via the short options, and then cap, or even worse, induce more risk if you get an accommodating move, which I'll show you what that looks like in a second. So the short options, it's kind of the inverse thought process as the in the money options. I'm going to go less than 60 DTE for sure. The vast majority is going to be less than 40, even closer, around 20 days maybe. They're going to be out of the money because I want them to decay as quickly as possible. Now, there's some considerations around what strike price you pick. This strike price is selected via delta. This strike price is kind of baked off of this one. So we have to be thoughtful. And it's not as simple as if we buy, let me grab this. It's not as simple as if we buy, let's say this 57.5. It's not as simple as just saying, well, we sell something lower than that, because the deltas matter actually quite a lot. And we'll get a little further into detail on how to think about the deltas in the position. So if I go to a risk profile, just to show you what this thing could look like. Here we have the standard ratio put diagonal. So let me get me out of the way so it's a little easier for you to see. And you don't have to worry about all of these other boxes and stuff. This is actually the old positions that I had. But here's our base trade, the long puts. As you can tell, we have unlimited profit potential, we have capped downside risk, and we suffer theta decay. Then we can add short options on top of it. In this example, for the short options, I went out 31 days to expiration, and I picked something that was like a 12 delta. Again, you can go closer to at the money. And if we want to take a look at what an example of that might look like, if I grab 5 of these and throw them in, oh, I'm sorry, the further out of the money ones, these ones. So this is essentially the difference between those two. And it won't look like much on this. You need to actually look at the P&L of the open if we get an accommodating move. So let's say this line right here. If we go down by 1 standard deviation, this trade makes 8,500 bucks. That's using the further out of the money puts. If we use the closer puts and we get that 1 standard deviation move, we get 79.80. So why is that? Well, because these are a higher delta. They're going to start chewing into your profit factor a little bit quicker because of the delta. So what's the trade-off here? Well, if you go closer to the money, you're going to make a little bit more money up front. I'm getting 72 cents here as compared to 15 cents here. So again, that's the next threshold you have to cross when you're choosing what options to select. We know how to select the long option for the short option. Once you get your expiration, depending on what fits in with your portfolio, then you have to figure out which delta within there. And this is the first trade-off. The trade-off is the higher delta you pick for your short put, you're going to collect more money up front, but you're going to give up more profit potential. Got to find what works for you. For me, it'll typically baked around a 30 delta or less. I really want to give as much possible profit potential to the base of the position, which is the long put. The other thing you'll notice is notice how light of a ratio this is. In this scenario, we're long 30 of these in the money puts and only short 5. Why is that? Well, we're not going to collect a bunch of money up front. That's pretty clear. However, if we start adding more, let's say we do 10, you collect way more money up front. But then notice what happened to your P&L if you get that 1 standard deviation down move. Now it's at 7,016 as compared to what you just saw it at 79.80. So this becomes an assessment of your conviction of the trade and how you want to produce returns. This is exactly the name of the game here. Now, the reason why I do a ratio is because if you look at a standard diagonal, which might have 1-to-1 or something like that, you actually end up with risk if it goes too far in your favor. And I don't want that. I want to have as much profit potential as possible, but I don't want any risk in my direction. Now, quick admin note. The reason why in this case with the 30 longs and the 30 shorts, it's the same, meaning there's no risk to the downside, which is where I would make profit, is because of the deltas I picked. These are such a high delta, they will cap out before these, but that will change as the long deltas move. So just an important note, the ratio is important to maintain. It might be a little bit misleading in the beginning of the trade because of something like that if you're selecting your deltas really carefully. So then comes the question, how many of them do you sell? It depends entirely on how much money you want to collect up front, and then how much profit potential do you want to give up to collect that money up front? Only you can answer that. For me, I typically would try to keep a few shorts on to offset some of the cost of time decay, but it is a secondary profit factor. Another thing is a lot of times the short option won't even go on at the same time as the long. Yeah, and it depends on the underlying and what it's doing, but very frequently I'll buy the longs and give them a day or two, even to see if my move is confirmed before I start adding the shorts, and then I'll add the shorts. And you'll see a little bit more about that in a hot minute. So that's the base structure. You now know a little bit about the kickers. I don't want to spend too much time on that because it's really a kind of a tertiary profit factor, but you know enough about them now to understand why they exist and why they're part of this. So what's the overall management approach here? For me, it's really simple. It's based on the charts. I'm going to primarily focus on technical analysis in selecting where I think something might go, how I'm going to manage risk, and then I'm going to attempt to follow the trend. That's the main management approach here. So my profit target will be defined before I enter, as will my stops. They will be defined before I enter. Now, a couple other notes that are important to track with this kind of strategy, and this is where it starts to get a little complicated. You can simplify it if you want, and I'll explain how when we get to that. But the way you simplify this entire strategy is if you're in this scenario where your short puts fall in the money, meaning it's moved in your favor a lot, and now the underlying, you have short puts that will be losing money. The way you simplify this entire strategy is if that happens, you buy to close the short puts, get rid of them, and then you sell to close the long puts, the entire position. That's the simplest way to trade this. Again, if you want to keep it super simple. Once you get your move, you close the shorts, close the longs, move on with your day. Now, quick admin note on that. More often than not, what I will do is sell maybe 5 of the longs first. I just want to assess liquidity, get a sense of where the market is so that I know what I'm walking into with the rest of the exit of the trade. And then I'll unwind the short options and then go back and finish unwinding the long options. Again, kind of minor detail, not a huge deal, but something to be aware of. That's the simple scenario here. Now, the more complex scenario includes if your short options fall in the money, we don't want to just book a loss on the short options. So going back to this as an example, let's say these 52.5 puts, which are trading for 72 cents now. Let's say that the underlying, we get a big move in our favor and the underlying's now down at 50. Well, these 52.5s are going to be showing a loss because they will be worth more at this point. So if you close those, you're just going to eat that loss. And I don't like doing that because I also want to make sure that I'm not realizing losses and not realizing corresponding gains that then can go away and also be losses. That's a terrible scenario. So what that could look like to play that out is if O drops, it goes down here to, again, 50. You're like, okay, this is moving big in my favor. I want to get rid of the drag from the short options and just let it be all long options from here. Let me get rid of these. I'll buy them at a loss. It's okay because these are making a bunch of money. Okay, so then you do that. But then what happens if O just rallies back? Now the profit that you were using mentally to cover this loss is now gone. And now this can even turn to a loss. So whenever I'm adjusting in the money, short puts in this trade, I'm either going to be rolling them to defer the loss, or I'm going to be selling long puts to cover that loss, which is important to track. And that actually leads into what this concept of a critical strike is. So this is, again, a quick synopsis of what we just looked over. So I'm giving this for you kind of a general reference. We can skip over it. And I want to give you some important kind of formulas and stuff. Don't let this overwhelm you. You can take your time looking at it and you can even modify some of these. But I'm going to walk through what the critical strike is, what the long option basis is, and what the short put lots are. Here we go. The critical strike tracks the overall position so that we know where we can sell short puts against the longs without potentially locking in a loss. That's the purpose here. So at the beginning of the trade, you can sell pretty much anything at the money. But what happens is as the trade moves around, as these deltas move around, sometimes unfavorably, it changes where you can sell short options against the longs and not lock in a loss. Now, the other cool part is depending on your platform, and you don't want to do that math, you don't have to. The platform can do it. So in this case, our short put strike is 52.5. If we go to 52.5, we can clearly see that we have a profit there. Great, no problem. But you have to pay really close attention to that because there can be instances where if you're getting more and more aggressive with your short puts, that you can lock in a loss. And especially with my methodology of selling the longs to cover the shorts, that can absolutely lock in a losing position. So that's what this is designed to do. And this is how you calculate it. You take the stock price less the long option basis minus the long option value, divide that by the long option delta. That essentially tells you where your critical strike, where you can start offering short options. Now, to get over to this one, to skip to this for a second, this tells us how many you can sell at the current delta. So essentially, if I input a delta here, this will populate a number for me. Now, again, you don't even have to do this. You can just essentially assess based on what your preference is for P&L, where you want to set your shorts up. Do you want to have 5, 10, 15, 20? If you're doing anything in this trade, you got to be able to buy more than one long option, at least 2, so that you can at least maintain some sort of ratio, right? You can have 2 longs, 1 short. This just makes sure that we're not selling too many shorts against the longs that if we get a big move in our favor, that we can eventually start looking at a loss. And again, to show you what that looks like in the platform, if I start clicking this, essentially when there's up, in this case, downside risk to the trade, I'm just doing way too many just to make it more apparent. But when there's risk in our profit favor, meaning down on the long puts, when there's risk in that direction, that's too many. That means that your short deltas can overwhelm your long deltas, leading to, again, risk in that direction that I don't want. So that's what allows me to track that. And again, your platform can do it just like I'm doing it right there by clicking that button. No big deal. Next up, we have the adjusted long option basis. This is also really simple. When I'm looking at this, I want to make sure I know what the actual basis of the long option is, including the total cost of the trade. So what I do is I modify the total cost. This is the total cost of the open options. And then I will take a look at the P&L, include those, and then I will divide that by the number of long options remaining times 100, because that's the multiplier for options. And then this will help me understand what the basis I can work with on the long options, accounting for the closed in the money puts. In this case, this should be puts, not calls. Get rid of that. That's that. So again, some of this stuff might be a little confusing. Take your time looking at it. This is just all internal tracking for me. You don't have to do this. If you have a platform like Thinkorswim, like I showed you, it literally will show you all of this for you. You don't have to worry about it. I think it's a good exercise to build this personally, but you don't have to. So that's kind of the basis of the trade. Now I want to work through an example with you. So let's take a look at this. This is O back on 22 Jan. O was trading around 55.75. You can see kind of where it was right here. And this was the opening trade. These were in the money, the 60 puts. I bought them for $5.25. And then I sold 10 of the 55 puts against it at 87 cents. So this was designed to be about a $20,000 trade in total. And the initial debit was kind of the majority of the position. And I tend to like to do it that way. I like being able to phase into the trade if I get minor moves against me, or if I get a big price accommodating factor in my favor. I like having some money to be able to add to the trade depending on my hypothesis. And this is what it looked like. The way that I found this trade is it showed up on a breakdown scanner that I run. And this was also within an underperforming sector. I like to stack strength with respect to my directional trades. So if I want to trade something to the downside, I like it when other things that are like it are also going down. It just adds a lot of weight to it. It helps things move in my favor in general. So the overall outlay for the position here was that 15,750. And then I collected a 870 credit. So in this case, 30 longs, 10 shorts. I'm weighing way more heavily the profit potential for the longs. Now, the way I look at establishing a stop in something like this is I will either use the high of the day, depending on what that looks like in the individual ticker, or I'll use near-term resistance wherever I can best see it. That's how I will make sure that I'm using stuff that makes sense on the chart. And then I will make sure that I'm okay with the resulting potential risk to the position. So for example, if I look at these 30, 60 puts and I put them on for 525, and then I look at where I think, let's just say, let me grab this. Oh, let's just say that I think it's something around the resistance. Let's just say I think it's something like way up here, whatever. If I use this and I think, okay, that's where my stop would be, what would my P&L on this position be at that stop? And am I okay with it? If I'm not, I either need to have a tighter stop, accepting the fact I'm probably going to get stopped out, or I need to size down the position so that the risk makes sense for what I'm putting on. So on the 26th of Jan, there was a kind of an interesting scenario where there was an immediate small price accommodation once we started accelerating to the downside. So I like this example because it walks through how I try to remain sensitive to the position. So when I entered on the 22nd of Jan, a few days went by, it started breaking down and I started seeing this weight carrying it down. So when I saw that I could get out of those shorts for the cheap, right? The difference here is minimal. The overall debit paid $9.50. I lose 120 bucks, but this is a scenario where it's starting to break down. I want to let it break down and I don't want these shorts to get in the way. So in this case, I don't add more shorts to the position. I want to let it break down. And that's why I cleared these out earlier. Again, you don't have to do that. You can just let it run its course until you get to the expiration of the options, but I'm very involved in the position personally. So at this point, the realized P&L for the position is negative 120 bucks. And then the long put unrealized P&L unrealized is 1,200 bucks. This is important. So at this point, I'm eating $1,200 and I'm very carefully monitoring it. Now, if I was being by kind of the standard textbook, or if this was a bigger loss that I just don't care about, I absolutely would have unwound some of these longs to cover the cost, the loss of this short. So in that scenario, I would say, okay, out of my 30, how many do I have to sell to make more than $120? That's how I would net that out. For me, this is a small enough loss that I just don't care. It didn't matter to me into the position. This didn't balloon enough. You'll see an example of those others in a second. So we fast forward time. Here is essentially day after, and we see this candle. What do you guys think? Do you think I should sell more short puts here? Should I not sell more short puts? Any thoughts? Throw them in the comments. What I ended up doing here was waiting. Why did I wait even though it looked like it was starting to base? Is I wanted to see. So for example, if this started heavily trending sideways, I absolutely would have been okay with selling puts at that point, but it just started to break down. So I wanted to give it time to continue breaking down. So we fast forward, and again, those let me take this away. You can see essentially how this trailed down and then what it turned into from that point, which was pretty big up day, but then it came back down. So overall, giving the trade as much room to move in my profit factor is the goal. So you can see now what I'm doing is sliding down my stops. I'm following the trade down. Now, these aren't hard stops. These are soft stops. My hard stop would still be at this point at the original P&L of the trade, meaning I would want to be able to get out at flat at worst now that I've had this much of a price accommodation. But I want to give it enough room to work, but I'm going to follow along with it pretty closely. So the way I would use these is by phasing out until I get to a hard cut point. Because as I phase out, essentially what happens is I now have the ability to book a profit at a higher level at the lower stops, and then a slightly lower level at the medium stops and all the way up. It allows the position to walk out at a decent profit, even if I'm being stopped out on the way up. Now, on the 16th of Feb, what I ended up doing was now selling to open 15 of the 15 March 50 puts. Why do you think I did that? Well, because it clearly started showing signs of strength. Take a look at the difference in these scenarios. In this case up here, it started showing a little bit of strength and then it fell off a cliff. Here we have 1 day, 2 day, 3 day, and then a big green upward candle on this 4th day. So that means that it opened way down here and then it surged all the way up and closed up here. So to me, this looks like it's starting to post some near-term strength, which is exactly why on this candle specifically, I was willing to offer more of these short puts. So those brought in a credit of 675. I still had a realized loss of 120 from up here, and then an unrealized P&L now of 87.75. So here's the net on the trade. Next, we go to 8 March. So as you can see, this is where I sold those puts, and you can see how the underlying behaved since I sold those puts. You can see where my stop is now. We are starting to get real close. So in this case, what I ended up doing was taking these puts down for a pretty big profit. I sold them for 45, took them in for 8 cents. So that gives me 555 bucks. That'll clear this loss out and put something in my pocket. And then the unrealized on the long options came down a little bit. And the reason why that came down a little bit is because the underlying started to go up. So that was the wrong direction for the thesis here, and volatility started contracting. So I offered 10 of the 19 April 52.5s for $1.20. That brought in $1,200. These were a higher delta now. I'm getting closer to the current spot price. Notice it was trading at 52.88. I got in at the 52.5s. Why did I go so close? Because I can collect way more money, and it looks like the move might be about done. So this is exactly why I take it from here to here. And as I sense it's starting to base, this is a long time that's trending sideways now. As I sense it's starting to base and the trade might be drying up, I will start repositioning the way that I set the trade out. But notice how I don't close the trade because I think it's drying up. Who knows? This could fall off a cliff and keep going to the downside. As you could tell, I'm purposely pulling up the charts at the time so that you could see what I saw at the time. In hindsight, everything is super clear. But right now, I don't know. It looks like it's basing. It looks like it's starting to gain some strength, but it also does absolutely look like it could roll over if it can't break up above this. That was the thesis at the time. And we get stopped out. So it trends sideways for a bit more. It looks like it's starting to accelerate to the downside, and then it gains its feet back, and then we get stopped out right up here. So this was the closing trade. I bought to close the puts that I sold for $1.20, closed them at 55, and then I sold all of the long options for $6.80. So this trade came out up 57.35, which is a 36.4% return on invested capital. Pretty simple trade overall. I didn't go through the cycle of selling some of the longs to cover the shorts. I only had one scenario where I was closing in the money shorts. And this is more so how I kind of prefer these trades to unfold in their entirety, like pretty simple. Now, the big thing that I want you to notice here is this isn't a small move, but it's not a big move. So where I ended up entering is trading around 56, and I only got like a 3-point move. It's not much, but it was still enough with leverage to walk away with something on that money. Again, making $5,700 on 16 is not bad at all. So that's how that trade essentially played out. It popped up via a breakdown scan. I knew it was going to be a shorter term trade. And by selecting essentially the delta that I did, which was around a 75, it found a really good basis. And the days to expiration on the original leg, you can see again, out to 17 May from Jan. So I ended up going here for the sake of liquidity, because when you're trading these kinds of things, you cannot forget about liquidity. All right, let's take a look at some of these questions. The first one from Don't Ask is, how much time and effort do you put in thinking through the path of the trade? About 0. It doesn't matter. I have a hypothesis when I enter the trade, and then I'm defining my profit and loss on entry based on my best guess. But the path it takes to get to either of those 2 points, I don't really care about. I'm going to kind of see how it flows. Then this one is, if your long option moves to at the money, meaning it's going in the wrong direction, and you honestly think you were just early, do you reset it or ride it out? It's a moot point, right? Because again, the P&L is defined on entry. So this will be defined before I even enter. If it's at the stop, I get out. If it's not at the stop, I don't get out. Simple as that. Can you go too far out in time with the long option where the structure doesn't make sense? This applies if you're using a really low delta. The reason why it applies if you're using a really low delta is if you go super far out in time and you have like a 10 delta, there's no gamma there either. So even if you get a big move, you're not going to see most of it. If you have a long in the money option with a high delta, 90 plus, 80 plus, you're going to see most of the move anyways. So it doesn't really matter. The next thing would be liquidity here. Situation where you would consider adding the kicker at any point during the trade between the short and long option. I think I covered that a little bit before. That's mostly just if I'm expecting some sort of big directional move in my favor and I want to be able to compound more efficiently. Next question from our boy Stray J. Stray J says, I think it pretty much covers it. Maybe you could highlight differences in management compared to a ratio called diagonal. Not much. I mean, it's obviously trading to the downside, so the way that you analyze downside moves might be slightly different. It is for me. A stock can really fall under its own weight as compared to what it needs to be supported up through these really voracious up moves. And the other thing is being mindful of the volatility interaction with the position, which is very different from a ratio call diagonal. Again, in the trade that I showed you, I got, again, not a big price accommodation, was less than 10%, but I still got enough. And as it started to trend back up and vol was bleeding out, it really took a lot of the P&L out of the trade. So got to be aware of those impacts, I think. Last one. Reek says, you talk about critical strike. Can you go more into that? I think that overall we covered that pretty far in depth here, actually. So I imagine we're probably good on that as well. So that's ratio put diagonals. And again, this honestly is kind of surface level. This is at a really, really high level. There's a ton to go into. Now, the last thing I do want to show you guys is a trade that I have on right now, which is in Roku. And the way that I found this trade was really simple. This popped up on a breakdown scan here, so I entered here. Original stop was at near-term resistance, at least what I deemed it as. And then as I started getting a price accommodation, I start sliding it down, and this is where it's at now. And again, today is the 18th of June. We'll see how it goes. Right now it's showing a profit, but not much. I haven't gotten a giant move yet, but I will follow it to the downside. I have inverted moving averages, nice and wide, negative price trend. It definitely fell out below this near-term resistance. After we cracked below this kind of short-term resistance, I front ran the move just a little bit. And yeah, the main reason why I got in here versus here is because this was a big, massive down day, a giant rejection at this level. So that to me was pretty bearish, and I was willing to play this move, even though I typically would have waited for a drop below here. I also looked back. This is really where there's way more support, right? There's one touch at this level. Over here, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, a ton of interactions with this level. So it was way more relevant to me anyways. So we'll follow this one all the way through. And right now that's looking like long 15 of the 60s at 626 and short 5 of the 51s. And again, these are out in 16 August. The shorts are at 5 July. That's all to capitalize on those details we talked about before. And it gives me way more profit potential. I'm weighting the long options as much as I can. So that's that. If you have any questions, let me know. Don't forget to subscribe, like the video. Be an outlier. See you guys later.